Hello everyone, welcome back to the channel. If you haven't noticed that every time the markets wobble, politicians suddenly start talking about protecting your retirement, then this video is for you. Because that phrase sounds reassuring, but once you look closely, you realize it raises a lot more questions. Are retirement accounts really being protected, or being used to justify risking a financial system that depends on your money staying trapped inside of it? When financial market needs the government risk, there's one thing that gets repeated more than almost anything else. What total intervention is about protecting ordinary people, protecting workers, protecting retirees, protecting the retirement savings. And that creates a strange paradox, because billions of dollars can be deployed to stabilize the failing part of the financial system, and the main justification it's been done in the name of American worker. But to understand how we got here, we need to go back to how retirement used to work. For much of the post-war period, retirement was built around the defined benefit pension. That simply means the employer put market risk in promise of work with guaranteed monthly income for life. In other words, the company absorbed it. The workers, on the other hand, got the check. That system started to unravel in 1980 with the rise of 401k. For employers, it was cheaper because instead of guaranteeing retirement savings, they could shift the burden of market volatility directly onto the employee. So what changed? Well, the risk moved. It moved out of the corporate balance sheet and onto individual workers. What at once then the corporate responsibility became personal gambling. And that was sold to the public, a very appealing story. You see, workers were told they were being empowered. You're not just an employee anymore, you're an investor. You can take control of your own future. But then as the system get expanded, the financial industry realized it had created something far more valuable than just a nation of empowered savers. It had created nearly 50 trillion pool of capital. And more importantly, it was captive capital. That term means a lot, because captive capital means money that keeps flowing in and it's very hard to take out. With automatic payroll deduction, retirement accounts receive a steady stream of cash. And once that money goes into a 401k, it is functionally locked away for decades. Because if you try to access it early, you face a 10% penalty. So for many workers, that cost of touching the money before they leave 50 is simply too high. And that gives Wall Street something incredibly valuable. A large, predictable funding source that cannot easily run away. Even during a panic, even during a banking scare, even during a broader loss of funds, that money tends to stay put. But before a worker's dollar ever reaches the broader market, it goes through what you could call an extraction pipeline. And the first layer of that pipeline is fees. You see, management fees mean small pay, but across millions of accounts, they pull tens of billions of dollars out of retirement savings every year. And because those fees compound over decades, they quietly eat into the long-term growth of personal life savings, regardless of whether the market performs well or not. Then there's where the remaining money gets directed. More and more of it is being pushed away from traditional public stocks and onto liquid private assets. These includes things like private equity, private credit, commercial real estate. Now, those are technical terms, but the core idea is simple. These are investments that are harder price, hard to sell, and often riskier than other public stocks. So, why push your time and money into those stocks or areas? Because 401k, is patient, and more accurately, it is trapped. Since workers cannot easily withdraw their money, funds managers can make long-term riskier bets without worrying as much about investors demanding their cash back to wall. And that turns the retirement account into a convenient home of asset that the broader market may not want to hold easily. In that sense, retirement accounts have become a major funding source of some of the most access to sell assets. They provide liquidity, meaning cash support for investment that open market were enthusiastic about. And here's where things get more interesting. In the public stock market, prices update constantly, thousands of times a second in some cases. Everyone can see where the market is moving in real time. But in many private assets, valuation may only be updated once in a quarter, sometimes even less transparently than that. So on paper, the assets can appear smooth and stable, while their real world value may be already deteriorating. That reporting lags matters a lot because it can create the illusion of calm while the line investments actually weak. Professional traders, hedge funds, and large institutions overreact quickly when trouble happens. They can reduce exposure, they can sell, they can rotate into something else. But the average retirement saver often cannot do that nearly as easily. And that's where the structure of the system becomes critical. You see, when an asset class starts to fail, mobile capital tends to move first. But the 401k pool acts like a walk. Because workers are penalized for pulling their money out, much of the capital stay locked in place, absorbing losses while first more flexible investor exit. This is not an accident. This is what happens when you do around capital participation. And when you combine tax penalties with liquid investment, the result is uncomfortable, but importantly, important to millions of ordinary savers and end up functioning final shock absorber for losses the rest of the system can no longer hold. That dynamic shows up in politics. Lobbyists routinely use people's retirement savings as a shield. A new regulation that might reduce financial industry profits can be framed as threats of retirement accounts or other requirements. And that framing is powerful as well, because no politician wants to be seen as attacking people's security. So when markets come under pressure, the government is pushed to provide support. Emergency funding, regulatory flexibility, backstop, and whatnot. Because if markets are allowed to fail too abruptly, the damage in voters' retirement account. And once retirement becomes the political justification, intervention becomes much easier to sell. This also supported by roughly $380 billion a year in tax breaks. Those tax advantages, however, are supposed to help the workers. But in reality, the distribution is far from equal. A very large share of those benefit flows to the top 10% of households. In plain English, people who already have significant wealth often receive the biggest subsidy for saving money they likely would have saved anyway. So the result is public subsidy, supporting a private system that often channels ordinary workers' retirement money into risk-taking structures that primarily benefit financiers. This is a very strange picture from the one most people are given. And to see where a system like this can lead, it helps to look at Australia's superannuation system. That is Australia's mandatory retirement savings model, and it has created one of the largest pools of captive retirement in the world. What happened there is quite revealing. You see, a large share of that capital was funneled to the banking system to support mortgage lending, and the effect was enormous. It helped for one of the worst housing affordability problems in the world. So in practical terms, workers' retirement money ended up helping drive up the price of the very housing market they themselves needed to access. That is the danger of captive capital on a national scale. It doesn't just sit passively in the background. It shapes the economy around it. So what can an individual actually do inside a system like this? The first step is transparency. You have to look closely at your retirement account. You have to check for hidden fees. You have to look at the private credit exposure inside target state funds. Verify what you actually want and make sure your allocation matches the level of risk you're taking. Because in many cases, what's being the old simple diversified retirement, when in reality, they may have more exposure to opaque liquid asset than they realize. Now, to be clear, savings and investing for the future is still important and necessary. And using tax advantage account is often one of the most disciplined ways to do that. That part is not the problem. The problem is pretending that the personal habit automatically makes the larger system itself sensible. Well, it's not. And we should stop allowing Wall Street to use our financial features for little cover for the regulation bailout and risk transfer. Because doing things responsibly inside the broker system does not fix the system. It does not make the system sound. It just means that you're trying to survive intelligently. If you find this analysis valuable, subscribe to the channel for more insightful analysis, thoughtful breakdowns on markets, money, and systems shaping your financial. Thanks for watching, and I'll see you in the next one.